Hi folks, would I buy this business? This is an absolutely incredible business. The fundamentals are extremely strong. $1.3 million underlying EBITDA for the last 5 years, very consistently, very consistent top line and gross profit line. But when you look a little deeper, there are some real nuances, and it really depends on whether or not you look at this business through the lens of optimism or whether or not you take a conservative approach. Let's dive into it. This business is a really niche business that provides mapping and tuning services in the automotive sector to also a niche part of that sector. Let's have a look at the revenue and the gross profit and the underlying profit first of all, because this will paint a little bit of a picture that we need to think about. We're going to look at this business both through an optimistic lens, but also take a bit of a conservative approach as well, so that we can figure out how, if we're buying this business, we can structure the deal. And we'll also primarily focus on structuring this deal with no money in. And when I say no money in, we're talking about this being fully debt funded. The business, is it going to be capable of also providing a cash return year on year? And when I say fully debt funded, this will exclude probably some minor transaction costs of say $20,000 to $40,000 if done properly. But let's dive into this. So, revenue, extremely consistent in this business. It's such a sexy business from a consistency standpoint. It has literally not fluctuated over the last 5 years from 2.7, 2.8, 2.76, 2.75. 2026 is actually sitting at around 2.8. So it's had an insane amount of stability over the last 5-year period. The gross profit also tells the same sort of story, except we have seen a little bit of an increase in 2025 compared to 2024. And this increase, pleasingly, has also been consistent in 2026. So there's about a 5% increase in gross profit that looks to have maintained through to 2026. In the underlying earnings, underlying EBITDA, we're looking at, again, a really nice level of consistency, 1.35, 1.43, 1.36, and then a jump up to 1.6 because all of that uplift in gross profit has flowed through to the underlying EBITDA line, as well as a little bit of extra depreciation in 2025 due to an asset purchase recently. We have a very healthy business. Now, one thing that stands out here, let's look at this from the optimistic lens. Salaries is incredibly low, and this is why I've just highlighted this expense column. Salaries, you can see there is really only one salary here. And believe it or not, this business is run with 2 people. Is that a good thing or a bad thing? Well, if you're looking at this optimistically, I would, in the context of the revenue, make an argument to say that the biggest bottleneck in this business is because of a lack of personnel, because 2 people just simply can't drive more revenue in this business. So is that a positive thing or a negative thing? Well, I think that's potentially a really positive thing, because it says if we increase the personnel resources, we can also increase the revenue. And obviously the cost model is so healthy that there could be upside in doing that. But before I would make that decision, I'd want to understand what the forward bookings calendar looks like. And is the business booked out 2 or 3 weeks in advance, or is it booked out 6 to 8 weeks in advance? If it's 2 to 3 weeks, that probably just tells us that that's fairly normal. But if it's 6 to 8 weeks, that's absolutely a signal that this business has a personnel shortage and the people in the business are, or the lack of people in the business are the bottleneck. However, if we look at this with caution, we might also think that there's a transferability issue here, because we only have 2 people in the business, and most likely, or there's a good chance that all of the skills, the know-how, the processes, the trade secrets, actually how they execute the work is stored up here, normally in the owner's head. Therefore, are we actually going to be in a position where we can transfer all of that knowledge so the customer base receives that knowledge in a year from now? So will this business transfer? Okay, now we know these items, how are we going to structure this deal so that we can put it together so that the buyer wins, the owner wins, the employee in the business wins, and the customer wins? Okay, so first of all, I just want to go through some simple assumptions that we're going to make. We're going to make an assumption that we're purchasing this business, including working capital, for $2.5 million. So $2.5 million cash in. We're going to assume that we're debt funding 100% of the purchase price, 100% of this 2.5 million. We're going to assume an interest rate of 10%, a term of 6 years, a company tax rate of 25%. This is where things get interesting and we start to de-risk this transaction. We're going to build in 2 salaries, not just one to replace the outgoing owner. We're going to build in another salary as well. Roughly $200,000 to replace the owner, as let's say the general manager, but another $100,000 as well, just to strengthen day-to-day operations of this business. We just want some assurances that we are not going to immediately be putting the new general manager under extreme amounts of pressure, and that we're able to spread some of the workload across another staff member. And this allows us to just really focus in this first 12 months of documenting every procedure, every standard operating process, everything in the business that happens on a day-to-day basis, and what we need in terms of getting all that information from the owner's head on paper so that the customers will receive that same level of service and quality in a year's time. We're also going to factor in a working capital provision, meaning that we're going to retain some of the forward earnings every year for any capital expenditure that will come up that will help to stimulate growth in the business or just provide a safety net of cash. And we're also going to factor in some share capital to the general manager on top of his salary at 2.5% per year, and that will kick in at the beginning of year 2. So it will first be a payable at the end of year 2, therefore a liability in the business at the end of year 2. So here we've created a pretty amazing safeguard because we're giving the general manager a $200,000 salary, plus over 5 years, he'll also own 10% of the business, have real ownership in the business, and that allows us to create ultimately a passively run business with very little oversight from the buyer. So does this business stack up? Is there enough profit in the business to actually make all of this possible? Let's have a look at our forecast. In year 1, after the 2 salaries that we're building into the business to replace 1 salary, we have $1.189 million of underlying EBITDA left. Then what we're going to do is minus the tax. We have $282,000 in tax at 25%. So therefore, our after-tax cash flow is $906,000. Then we're going to allow for a working capital provision. This leaves us with $728,000 of available cash for debt service. We service the debt at $574,000, and we have net cash flow to the buyer of $154,000 at the end of year 1. Now, gradually, this will cascade down as the GM incentive increases. So in year 2, there will be $121,000, in year 3, $103,000, and so on and so on. However, the great thing about this investment case is that at the end of year 6, number 1, the business has been paid off. There is free cash flow to the buyer every year, which is not insignificant. It's quite substantial. And at the end of year 6, we have an asset that's worth roughly the same amount, $2.5 million. Plus we have then free net cash flows to whoever has bought this business of $604,000 per year. That is after tax. That is run passively. Now let's just take this as a comparison to, say, another asset vehicle, which would be buying an investment property. It's almost impossible to have the investment property fully, well, not almost impossible, it is absolutely impossible to have the investment property fully paid, debt-free after 6 years. What you're not going to get in when you're purchasing a business is it's unlikely you'll get the level of capital growth. However, you are getting a significantly higher level of cash flow. This is why we have experienced a large increase of buyers who are coming to the SME sector, who traditionally would have been property investors. They're starting to see the SME sector, yes, as being something that is more risky. However, they're starting to see the SME sector as something that is becoming viable in context with the lower levels of returns and the increased risk that they are having to adopt in the residential sector. It is getting harder to do residential flips. The margins are getting tighter and have been so for some time. We've had probably in the last 2 weeks, maybe 10 buyers who are new to the SME sector. However, they're bringing skills that are transferable. They're typically blue collar buyers. They typically have significant amount of equity, but their household income is not keeping up. They don't feel like they're getting ahead. So these buyers are calling us saying, we can access equity. We want to move into a business, but we don't really know how to do the transaction and how we can structure the deal. We expect this trend to continue further and continue further, because what purchasing a business will do is it will give you far stronger cash flows. It will allow you to pay down the debt on the business a lot faster. It can be absolutely possible that you can move into a transaction with very little to no cash down. It's not easy, but there are different ways to do it. And imagine just doing this 2 or 3 times and how much this could impact your household income, number one, and your wealth generation over the course of a 10-year period.